Hey, good morning, Jay. How are you this morning?
Hey, John. How you doing?
Looking forward to the show for the last 2 weeks. Missed you in the last week.
Yeah.
Yep. Up to a lot of fire business, fire reporting.
Yeah, we're shooting tons of stuff for Ukiah Valley TV.
Well, I've been following your very excellent reporting on Ukiah Valley TV.
Yeah, thanks.
Thank you. And I'm sure a lot of citizens in the county agree. Well, it's been a bloodbath in the market since we last met here at the station and did our show. Yesterday we had a virtual collapse in the stock market. Also, just an astronomical jump in the rise of commodity prices, and I'm going to go into a little bit of a market recap in a second. Again, just apropos of our first show and our first guest, Tim Knudsen. Again, our $400 million in county pension assets look as unhedged as ever and as vulnerable as ever. Let me just give you a quick recap on what happened in the last couple of days. First of all, as I said, the market collapsed yesterday. It collapsed by 358 points. This was the worst June in the stock market since the Great Depression, Jay.
Wow.
The worst June since the Great Depression. And again, a lot of pension fund managers out there, including our own, remain completely unhedged in this market. And just to do a little turn of phrase, I would venture to guess they remain unhinged. So the market collapsed. It's in the beginning of the year. It was about, Dow was at about 13,000. Yesterday, it closed at its lowest since September of 2006. It closed at 11,450. Leading the collapse was the financial sector, which is a pretty ominous sign. Merrill Lynch, Citigroup, Bank of America, all led the decline. That's ominous because usually you look for strength in financial markets to be led by financial services companies. So to have a decline being led by the financial services is usually a pretty good indicator of more bad news to come.
So internally, how is that lead manifesting itself? I mean, what's UBS doing?
Well, it's funny you should ask about UBS. UBS is in the news, is actually on the front page of the business section of today's New York Times. UBS probably has more problems than it has hair on its collective head right now. And the most recent bad news for UBS is that the Attorney General of Massachusetts is suing the company for basically pumping something known as auction rate securities from its institutional underwriting desk to their retail investor public, to the little investor. So they had a lot of stuff that they couldn't sell on their books. Whether they knew it was junk or not, the courts will determine. But the executives of the company were pushing it on the small investor, and UBS by no means is alone in this type of business practice. I dare say this is probably not a broker dealer out there that hasn't been guilty of this practice at one time or another.
And is everybody still short in Lehman Brothers?
I know I am. Lehman Brothers is a very good example of the kinds of problems that Wall Street is facing right now. Lehman Brothers may very well be the next Bear Stearns. A lot of our listening audience knows that Bear Stearns collapsed a couple of months ago, and that it required a Fed bailout by the Federal Reserve System, basically to the tune of about $36 billion. That I may add was shifted to the American taxpayer. Kind of a hidden tax on a Wall Street failure, shifted to the American taxpayer, and by no means was Bear Stearns alone in being overleveraged and being reckless in the type of proprietary trading and hedge fund trading that it was sponsoring. And by no means was it alone in its lack of financial controls.
And so, speaking of financial controls, what and why did the Fed not do anything this week?
The Fed didn't. That's what's driving this bear market right now. The Fed announced this week that it would pretty much keep rates at 2%, and it's keeping rates at 2% because it fears for inflation. Our first guest, Doug Henwood, will be speaking on something called stagflation in a moment. and it's very apropos to what the Fed is thinking about at this point too. We are in a recessionary mode, but if we raise interest rates, we raise the risk of driving inflation, and with oil trading at $140 a barrel, and with agricultural commodities also trading at record highs, we don't want to drive inflation any more than we're doing right now. However, if we lower the rates, we will increase liquidity in the system. So we're kind of in a bind, and there's a precedent for this in the United States, and that was during the first oil crisis of the early 1970s, when OPEC kind of asserted itself, and the United States entered a period of stagflation as well. Just to go through the market recap, we mentioned that the Dow has collapsed from 13,000 to 1140. This was the worst June since the Great Depression. Just to give you a couple of examples of how bad the news is, General Motors, the stock price of General Motors closed at $11.43 yesterday, which was the lowest it's been in 34 years. So those of you who think that our country is not in trouble, our economy is not in trouble, those of you who manage our pension assets, who believe that we should remain unhedged, think again. General Motors is a bellwether